This is a continuation by video of the example that we were talking about in class today, the Jacobs Chapter 3, page 57 example, which is described as a base case for any project. And one of the interesting components of what we're looking at here is this net present value and the reasons for doing that. We could go ahead and do all of this without the net present value calculation, but the net present value inclusion of that will actually show you how you compare against a less risky, steady investment like a T-bill or a T-bond, anything that is like a bank, anything, a bank instrument there, where you can expect regularly periodic payments, usually over a month, but in our case, we're going to look at it as far as a quarter. And so just a quick review, we have some initial starting information here about some costs, numbers of units produced, cost per units, and how much people are paying for this. The customer is paying $800 per unit out there. We're making exactly as many as we sell. It's rough cut at the beginning of a project. You say, hey, what if we build 20,000 per year and we sell 20,000 per year? And the comparison here is some other investment we can consider putting our money into at 10%. So if we could find an investment for 10%, does it pay to go through all this problem here? And with all the risk, does it pay off at the end? Does it pay better than 10%? That's what the net present value is really talking about. So the net present value note here accounts for alternate investments. It's the opportunity cost. This is directly what we've been talking about, is how do we figure out which of two different investments to make? Well, this is one example of how to do that. It has to do with regularly scheduled payments. There's installments or financial account period. The payments don't have to be equal, but usually the time period is regular. Okay, they are equal. Okay, over a month or a quarter or a year, whatever it is that we're using as a period here. The net NPV represents investment followed by payback over time, or an account for net cash flows, or it accounts for net cash flows for ongoing operations. Okay. So leading from that, the NPV has to do with the time value of money. Okay, and the NPV is equal to our initial investment plus a discounted payment for period one. So period one net cash flow dot D, that means it's a discounted. It's a payment from period one, but we're using that as a discount. First period will be a factor raised to the 1. The second period would be a factor raised to the 2. The third period would be a factor raised to 3, and so on and so forth, because we're going to come over here, and this explains that. This is the equation for net present value. For a string of investments, or a string of payments rather, that come in the future from I equals 1 to n, okay? So I would be after the first term is up, after the first 90 days. Let's take a cash flow photograph, what we got there, a picture of a snapshot, and then see what the discounted flow is. So over the next quarters, in our example, we have 4 years times 4 quarters is 16 quarters. N here would be 16. I equals 1 to 16. Okay. You take the value from that period. See, it says value sub I. So the value from the first period divided by 1 plus the rate raised to, in the first case, 1. So anything raised to 1 is itself. Okay. Then when you look at this and go through it again, you add the next period value. So you go value of 2, the second period, value sub 2, 1 plus the rate squared. Okay. So any number greater than 1 multiplied by itself is going to be increasing. You're multiplying it as a larger thing. As we go out, the denominator keeps getting larger and larger. And if we had equal values for every period, our net present value for that period goes down from the previous period over and over and over again. So it's a diminishing return, or a diminishing number as you go out over periods. Okay, so I just wanted to warm ourselves up with something like that. Move these out of the way right now so we can take a look at the rest of this. Okay, so we should be safe by putting it down there. Okay, so the blue blocker here, just so that we can analyze it. We went over this in class, but by using this, it actually makes it easier on our eyes. We can take a look at it and just ignore the things that aren't important at the time. So there's a development phase, a ramp-up phase, a market and support phase, and a production and sales phase. Okay, and they break out into a series of costs. So they not only are on the calendar here, 4 quarters for a development phase, 2 quarters for a ramp up, and then ad infinitum for marketing and support phase that takes money out of our system. We actually we have expenses around marketing support, but then production and sales, we have the cost of producing a unit, but then we have the revenues from the sale of the unit. Okay, so that's when we get into this phase here, we're going to have to see whether we're going to be making any money or not. That's by the second quarter of year 2. Right here, it's all vertically aligned. These are vertical alignments here by quarter. Okay, so we looked at the development cost. It was $5 million over 4 quarters. We made use of a key in our spreadsheet here in case we ever want to change these numbers up here. So the development costs were estimated to be 5 million, and so we used a formula in Excel here of C2, which is the development costs, and you'll notice that we're using the absolute version of that. We're using the dollar signs before each of the column and the row reference there. Okay, so that doesn't change. Okay. And so once we calculate that once here, we just put in this simple formula for the cell, and then we can just copy that across the row like that, and you can see it drops in identical numbers across that. So we've spread our development costs out over 4 quarters. We've spread our ramp-up costs over 2 quarters here, and marketing and support. Notice that like each of these events, each of these costs coincide with the event. So marketing and support started in Q1 of year 2, and you can see that those expenses started there. We said $1 million over each year, so we took this cell is equal to the marketing and support annual cost of $1 million per year, and divided that by 4 quarters. Okay, and that's where we got that from. And once again, you can just, once you do calculate that once, create the formula once, you can carry through. And usually the biggest errors are that you didn't use an absolute reference in your cell and it blows up. And you see that and you fix it, and it's no big deal. Excel, once you get it figured out, the repair is as fast as the error. You can fix it pretty quickly. Okay, so what we had to calculate here is they're forcing us to say, okay, we have 2 million items, 20,000 rather, items per year that we're making, units per year. So 20 over 4 quarters is 5,000. The cost of each one is $400, negative number, right? And then we net that out. So we 5,000 times minus 400 is $2 million. Okay, so it's costing us $2 million to produce what we're about to sell. Well, let's see how much our sales are going to be worth down here. So now we're producing, we should be selling the same 5,000 we sell we make 5,000 a quarter, we sell 5,000 a quarter. This again is a base case. Okay, so it's a simplified version of it, somewhere to get started, and you can use this over and over again. Okay, so 5,000 times 800, sales revenue $4 million. Okay, so that's not bad. I mean, we're actually got, as far as unit cost goes, we have a 100% markup on that. Okay, right. So you can see, you just keep copying these out over the other quarters. We enter a steady state. You can see nothing really changes after Q2 of Y2. It just runs out forever. Okay, if only the world worked that way. But remember, this is a simplified base case here. Okay, so what we want to calculate is, if we come down to this equation here, for every net cash flow we have, we can discount it. Okay, so that's where we're going to go with this. Column by column, we're going to show the discounted value here. Okay, so to begin with, we do the period cash flow. Right. Let's take a look above here, just get enough on the screen. And the first period, the only thing we did was spend $1.25 million in development costs. Same for period 2, period 3. But then we spent some more money. We're going into ramp up. We're getting our factory ready, and we're hiring people and getting equipment and everything. And so the fourth quarter, we had a bigger hit. We had $2.25 million expense then. We're now finished by Q1 of Y2. We're finished with development, and we've started marketing. So we're spent out $1.25 million Q1 of Y2. But now we're in production. To go all the way up to the top again, we've got into production here by Q2 of Y2. Okay, so we have some costs with manufacturing, cost of goods sold type of thing, direct costs, and then we have the sales. Okay, so the sales at first blush $4 million is a lot more than $2 million, twice as much. Hopefully we're making some money on that, and lo and behold, we made $1.75 million that month. We took in that much more than our expenses. We took in $1.75 million greater than our expenses. This is netted out, period cash flow. It's a net number there, okay? But now we want to calculate the present value on each of these terms. And I'm going to show you two different ways to do it. The first way is the primitive way, where we take the definition per se down here, and we don't use any special functions from Excel, okay? So just by definition, we come in here, and for every period, remember this is the 0th period here, okay? This is the first period. As far as an index number goes, and as far as concerned with applying interest or applying the discount rate, okay, this is period 0, period 1, period 2. If you go back to the equation here, the 0th term, if you remember, anything raised to 0 is 1, and that's why we divide the value. The cash flow here was minus 1.25 mil divided by 1 is itself. There you go. So we actually applied that, and that's how it works. So when we look at the equations that we used here, it was simple enough. There's something I could go back and show you a little bit. I could put that in here so it's more explicit that that's the 0th term. It's a little superfluous, but let me see if I can get back to that. The second term here, and what I want to do really quickly is just convert all these numbers here to some kind of financial representation. We're going to format this as currency, and I'm going to take the big thing is I wanted to get rid of the zeros, and I don't want to use the dollar. Okay, don't want to use the dollar symbol there. So we have negative numbers, and it's stuck in the commas for us. We didn't type those in. It's sticking the commas in there. Let's see if we can get rid of the commas. Can we do that? Go back to number, and let's not use the separator. Okay. It's up to you which way you like that better. Excuse me, but this flows a little bit more with the same format up here. I just didn't want the point whatever over here for the cents. It was throwing our eyes off here. So now we can see this. Now the second quarter would be like the first period that you apply the discount on there. Okay, so this is the first I equals 1 on this, and so you're going to be dividing the value by 1 plus 0.025. So it's going to be 1.025 raised to the 1, which is itself, and that's where we get that value from. And you can see that's how this is how we're calculating it. So C31 is the value, and we're dividing by 1.025 raised to the first. Okay, and for each subsequent period, we change that index. See, we're raising it to the second period where discounts apply. Okay. The first one is you just spent the money. Okay, so the first one is today, so you don't have to apply the discount. I hope that's clear. Sometimes when you get into Excel, you get into finance, you have to define whether you're counting from the first day or the last day of the period. So we're basically going by the first day here. We spent $1.25 million the first day. There's nothing to discount there. It's not the future. It's right now. Excuse me. Hopefully that explains what the difference between the quarter is and the period number that we're getting into. Hopefully that's not, let's hope that's clear enough. Okay, so as we march across the page, you can see that each term is raised by which period it's in. Okay, now I'm going to show you something that you can do. Okay, so the first ones here, I hard-coded the exponent into that. So we use the caret to raise a number to an exponent, and the exponent, this is what we're putting in here, this 1 plus the rate to the I. And the first examples that I did here, I actually hard-coded that period in there. In Excel, you tend to not want to do that all the time. So you'll notice when I go to this period here, I start referencing a cell. Okay, so how did we do that? I think I explained it in one of the classes today, but if you come into G12 here, I did something, and look, even though it looks like there's nothing in that cell, there's a 5. So what I had done was I had taken this row and turned all the text to white, but I needed an index number somewhere in each of the columns, and that's where I put it. So you can see them lightly colored in there, and if I turn them on, then you'll see if I just show it in black, they're sitting there. I just hit them by making them white against a white background. You don't see it. So that's why I'm using the references down here now. Once I come down here, you can see it's raised to the G12. So whatever's in G12, that's what you use. Okay, so G12 is 5. Okay, and then for the rest of the terms, I just use those indexes along here. Okay, and so we calculate, instead of 125 million here with the discount, it'd be minus 1.19 rounded. Okay, 1.19 rounded million dollars. Okay, so we come across this row here. For every column, we have our present value. Now, all we have to do, if you look at the equation, is add them up. So here's our equation. Just says add them all up. All right. And so if we do that, let me bring this down. Okay, so the first approach to this I just need to set up these boxes here so I can help you keep focusing on the cells that matter here. Okay, so let me get this one over here, this one over here. So okay, so now I can show you some things here. Okay, so it comes out to $8.2 million, and what we're saying is we make net we make $8.2 million more than an investment at 10% of the same amount of money. That's what NPV is about. Is this better be a positive number, this NPV, to show that we've made the correct choice in the world of opportunity cost. Okay. So one other item that I did add in one of the classes today that I wanted to describe is another function that you want to show is cumulative. We're seeing month or quarter by quarter here. We're seeing what the net cash flow is. If you add these numbers up as you go along, it's somewhat of your bank account. You've spent $1.2 million here. You spent $1.25 million here, $1.25 million here. So I'm using the non-discounted row here. And again, like as I did above, as I highlight this row, you can see numbers beneath this. And if I turn them on, what I calculated was, this is something you're going to probably want to do. It's nice to know. Shouldn't we know at each month what a soft bank account number would be, or soft bank account figure would be? This isn't precise. There's some adjustments we need to make. But again, we're in base case here. The first month you spend out $1.25 million. We're going to use this row up here, not the discounted row, but the regular row. I just want to show you how this works. Okay. Okay. So one thing that you might want to add to what they've worked on here is a balance, and that is just accruing or aggregating across period to period, adding that period's cash flow to a balance. Okay, so the first month you've spent $1.25 million, and your bank account would show minus $1.25 million if you had started with $0 in there. The second month you spend another 1.25, so obviously you add minus 1.25 to minus 1.25, it comes out to 2.5. You're 2.5 million in the hole right now. Add another month, you're 3.75 million down. Add the fourth period here, you're down $6 million. The fifth period, you're down $7.25 million, and if you notice, that's the deepest you ever go. This is the number you need to ask your Uncle Bob for. You need to go to your Uncle Bob and say, I need $7.25 million. That's how you read this. Okay, so that's your budget. You need to know how deep all your spending gets you before you start coming out. And now it starts making sense because the production and sales begin in column G. We have our first revenue in here. We also have an incurred expense because we produced some goods. But we can see that we became net positive month over month here, where we're beginning to start taking in more than we're spending here. Our bank account rose by something on the order of roughly $2 million that month. Okay, so we're down 7.25 million here, and then everything's rosy. Once we get into production, we're selling at a good clip. We have 100% markup, and our profit margin is pretty good. So the first thing is the inflection point. We go from sinking at this point to rising back up. And the other interesting point would be here where you've gone positive for the first time, somewhere between Q1 and Q2 here of year 3, you've broken even, your break-even point has been achieved, and from there on out you have a positive account. You can breathe easy and you can pay off all those people that you took loans from earlier on. Because if you notice, we didn't show anywhere where we're borrowing money here. But anyway, I just wanted to show that's a very important line that can reveal quite a bit. It's the classic startup line. Your negative spending and your investment to begin with, and then coming out with a positive slope on your net month-over-month sales. A positive track net. Okay, so let's get to the NPV. The NPV we calculated to be $8.2 million. We did that through an interpretation of the equation where every month we just figured out what the cash flow for that month would be discounted. Okay, so here's the actual cash received, but what we do forecasting of the future is we said that's valued at something less. Okay, and that's our PV as explained before. We add all these numbers up. So if we add all the numbers up, you're going to get 8.2 million. And if you look at the function or the formula used there, it's just simply a sum of all those numbers. Now, there's a built-in function. I just want to show you this. Let's get a little bit more elaborate with this. In Excel, there's a function for net present value, which we'll show here. Okay, so the function for net present value, as you will see, starts with the rate. So the periodic rate or the period rate is 0.025, and that's what we put in here. I could have just as well used our rate from above, and let's do this. What I'm going to do is highlight this, and instead of hard coding it in there, let's use what we started with here. We're going to put that in there over 4, okay, as we've gotten used to. Hit enter, and we come up with the same number. So we just improved this formula by referencing our key at the top. So if we change our discount rate, all the other numbers would flow through the entire thing. I just want to bring that out. It's how I use Excel. A little bit more elegant and maybe error-free, okay? Now, we ended up with the number 9.452. Why is that? Well, if you look at the range we use C31 to Q31, and C31 is here. The reason is you start with the number representing the first period that the discount applies, and it really doesn't on the first period that we have here. So the difference between our 9 million and the 8 million, you'll find out, is that negative 1.25 right there. See, I said let's put in B32, which was this number right here, and we add them together. I do a simple sum down here, and you can just see that if you sum them together, you use the NPV function, and wow, that's really cool. Okay, 8.2, it really worked. Right out to 99 cents. Well, that's pretty much it. That's the end of the problem here, and it kind of explains how to take a look at a project and figure out whether it's more valuable than something that offers you 10%, in this case, a return. When they usually think about that, it's a regular, safe investment with regular return on it. Hope that helps. Give me feedback. Thanks very much. I'll make more of these videos if everybody's appreciating them.